And welcome back to Financial Education. My name is always Zach Collins, and today's video is not going to be a video for everyone. I think everyone should know about it, and it's something to aspire to, but the content is not realistically going to be something everyone will need to know or even be concerned about. As I said, it's quite a niche topic, but also very interesting. If you're a finance nerd, you'll enjoy it. If you're super wealthy, you probably want to be across it. If you just want to hear about how to 10x your money in 10 seconds, yeah, this video is not for you. Now that we've explained what I'm not talking about in the most roundabout way possible, what is the topic of discussion in today's video? We'll be talking about Division 7A of the 1936 Income Tax Assessment Act. Before we get into that, for those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FASA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I chose to leave the industry as I couldn't stand the owner of the business, and his firm was very heavy in sales. I've got no interest in sales. Being a financial advisor is not all about sales, and my passion is to help people, not to sell various managed funds or insurance products. These days, however, I work in tax and compliance. Now, if you think Division 7A sounds boring, it kind of is, but it is super important to our taxation system and is a law that people with a lot of money try some really weird and interesting ways to get around it. If you've never heard of Division 7A, what is it? An easy way to think of Division 7A is that it's an integrity measure to counter interest-free loans from companies to the shareholders and their associates. You might be asking yourself the question, why is this something the tax office and government is trying to stop? Because theoretically, there are two ways that you can extract money from a company. Actually, let me stop you right there. The first thing you need to know, and I mentioned this in previous videos, is that companies are their own separate legal entities. Just like you are an entity, and you're separate from your partner, from your families, from some random person on the street. You're all distinct people. A company is the same. A company is a unique legal entity that is separate from the shareholders and directors. This means that all income generated by the company, all expenses incurred by the company, all assets owned by that company, and all liabilities owed by that company relate to that company. If this company, for example, is making a ton of profit and starts to build up its cash reserve, what happens when they have so much money they can't possibly use it effectively to grow the business? This is where we get back on track and talk about the two ways that you can extract money from a company. That's either through a dividend or a loan. If a company pays a dividend, it means that whoever is the receiver of that dividend will then pay tax on that dividend, because dividends are classed as income and they've now been paid some income. A loan, on the other hand, needs to be paid back. And if it needs to be paid back, then technically it's not income. And so, therefore, the people that control these profitable companies try and use loans to get around paying tax. And that is where Division 7A comes into force. When most company directors want to loan themselves money, who doesn't want to do it, at no interest? If I can have an interest-free loan, why wouldn't I take it? These people consider the business assets to just be an extension of their own personal assets, even though, as I said earlier, that a company is its own legal entity. A company assets belong to no one but the company. These people, however, don't see it that way. And because the director thinks that they own the company assets, that's what they do. They will buy a car in the company name and for company purposes and claim tax deduction, but they will use it personally. I've seen it being done with a Ferrari. Now, can you name me a company that needs a Ferrari? Other than luxury car dealers, none. There's no scenario where a company needs a supercar. This example is not fully Division 7A, it's probably more FBT, but it's the same principle really, using company money and company assets for your personal gain. Generally, what these people do is they will use this company bank account and they will fund their lifestyle. They will pay for their rent or their mortgage or Uber Eats or holidays, whatever they spend their money on. The difference is that it's coming out of the company bank account, not their own. I've seen lots of people on Reddit talk about where they say they'll just lend themselves the cash. They'll put it in their own offset against their mortgage, and then at the end of the financial year, they'll pay it back. There are also people that will just lend it to themselves and never pay it back. I've seen an example of this where the company lent funds to the brother-in-law of the director/shareholder back in 2005. that loan is still outstanding and there's been no repayments made on it ever. All of these scenarios will be considered under Division 7A and will result in either one of two things happening. Either the ATO will deem the amount as a dividend. Now, what is a deemed dividend? So the company doesn't actually need to pay you a dividend. The company will just say, this is not a compliant loan under 109N. The amount you've given, whatever it is, let's say it's a $100 dividend, $100 loan, or a $100 million loan. Whatever the amount is, we will consider this amount to be a dividend, and thus you've got to pay more tax. If the ATO does deem it to be a dividend, they will initially deem it as unfranked. However, under 109RB, the taxpayer can then request for this amount to be a franked dividend. If the deemed dividend is unfranked, it means that there's no franking credits, which these high-earning business owners do not want. If you don't know what franking credits are, basically it's tax that the company has already paid on the profit. If the company makes $100 in profit, they pay $30 to the government. If the company then declares a fully franked dividend of $70, this means that essentially you'll be paid $100, which is made up of $70 in cash, and $30 is a tax offset. You don't need to pay the full tax again. You just pay the extra little bit on top of, to top it up to your marginal tax rate. And this stops the issue of double taxation. There are a lot of ways that people try to get around Division 7A. And like I mentioned before with the offset account, what a lot of people do is they will transfer the money at the start of the financial year and then pay it back on the last day. This way, the loan is not on the balance sheet of the company when they do their accounts. They will then transfer the amount right back to themselves on the 1st of July at the start of the new financial year. Smart, right? Well, no. During an audit, the ATO will ask for your bank statements. They don't actually need to ask. They can go straight to the bank and, grant them whether you allow them or not. Anyway, the ATO can see these transactions, and this directly contravenes Section 109R, as they're making sham repayments, and it means that this amount that they're paying to themselves will become a deemed dividend under 109C. The other common one is using interposed entities. If you don't know an interposed entity, it's where there is another entity between the transaction. To make it simple, let's think about your job. Let's say your work has a few levels of management. You do the day-to-day work here. You then have a manager that oversees a few staff, and then above them is, say, the owner. The manager in this case would be considered an interposed entity. The owner will create the work. The boss will then tell you about it, and you do it. At the same point, you give your results to the boss, and then they give it to the owner. You and the owner are communicating through this middle manager. And that is how interposed entities work. Interposed entities make it a little bit harder for the ATO to work out these loan structures, but believe you me, they know exactly what's going on. It doesn't matter how many interposed entities. The ATO can and they will trace it. I've seen scenarios where there have been multiple payments of varying amounts, up to 10 entities at a time, and the ATO ultimately traced it back to the basics of Division 7A and the use of interposed entities under 109T. You can enter a compliant Division 7A loan, and this falls under 109N. The interest rate charged on this loan is actually quite high, and it's above what you'd expect from a third-party lender. The reason for this is to discourage the use of these loans. When you do have a compliant Division 7A loan, it will either be on a maximum of a 7-year loan or a 25-year term. So 7 years is for the unsecured loan, while 25 years needs to be secured against something. Normally this would be a property. So these loan interest rates, they vary year on year, so you need to make sure you keep up with the minimum yearly repayments, also known as MYR. The ATO publishes this rate every year before the new year starts. So you've got no excuse not to know what the rate will be and the amount that will be charged on that Division 7A loan for each particular income year. There was a great Division 7A calculator online that I'll link below. Please make sure you use that to calculate how much the MYR would be for any specific year. It can tell you whether you've met the minimum repayments or you've had a shortfall based on the amount you actually repaid on that loan. I have seen examples of people that have created their own spreadsheet to make the calculations around the MYR and interest repayments on that Division 7A loan. And let me tell you, it was not correct. Make sure you be careful with the repayments on Division 7A loans, as if you make a shortfall on the repayment, that's immediately a deemed dividend and extra tax straight away. Hopefully I've been able to give you a bit of a better understanding of Division 7A and some basics on how inter-entity loans work. If you've got any more questions, please feel free to drop a comment below and answer if I can. Thank you guys so much for watching, and I'll see you on the next one.